The Little Book That Still Beats the Market by Joel Greenblatt. Let me tell you about a kid who's absolutely crushing it. His name is Jason, he's in 6th grade, and while his classmates are worried about homework, this kid is quietly building a business empire. Picture this. Every morning, Jason rolls up to school on his scooter, probably with a bit of syrup still stuck to his cheek from breakfast. But here's where it gets interesting. This unassuming 11-year-old has figured out something most adults never will. He's discovered the beautiful simplicity of profitable business. His operation? Brilliantly straightforward. Jason buys gum at 25 cents a pack. Each pack has 5 sticks. But here's his genius move. Once he gets to school, he sells individual sticks for $0.25 each. Do the math with me here. He's turning 25 cents into $1.25. That's a full $1 of profit on every single pack. Moving 4 or 5 packs a day. This kid is making more than some teenagers with actual jobs. Now here's where it gets fun. Imagine Jason approaches you with a proposal. Give me some money, and I'll share half my profits with you until I graduate high school. What would you pay for that deal? $1,000? Maybe $500? What about just $1? Obviously, you'd pay $1, right? The sweet spot is somewhere in between, and figuring that out is literally the most important skill in investing. It's what separates the gamblers from the wealth builders. Today, we're diving into a book that cracks this code so elegantly, it feels almost too simple to be true. It's called The Little Book That Still Beats the Market by Joel Greenblatt, and this isn't your typical finance textbook that puts you to sleep by page 3. This is one of Wall Street's most successful investors, writing in such clear, simple language that he originally created it for his own kids. He wanted to give them something priceless, a roadmap to financial independence. And here's where it gets wild. Greenblatt claims he's discovered what he calls a magic formula, a simple, step-by-step system that anyone can follow to consistently beat the market and outperform the pros, with less risk. In his 17-year test period, this formula turned $11,000 into over $1 million. I know what you're thinking. If it's that easy, wouldn't everyone be rich? Well, that's exactly the beautiful paradox we're about to unpack. By the time we're done here, you won't just understand the formula. You'll understand the deeper wisdom of why it works, and more importantly, you'll discover the one psychological barrier that stops most people from ever benefiting from it, leaving the door wide open for those smart enough to walk through. This isn't just about stocks and spreadsheets. This is about human nature, patience, and seeing money in a completely different way. So let's start with the basics. Where should you put your money if you actually want it to grow? You could stuff it under your mattress, but that's basically financial self-sabotage. Inflation quietly eats away at cash like termites in your walls. What buys you lunch today might not even cover coffee in 10 years. Your money is literally shrinking while you sleep. The bank is better. They'll pay you some interest, maybe 5% annually. Park $1,000 there, and in 5 years you're looking at around $1,276. Not exciting, but definitely better than the mattress scenario. Or there's government bonds, which is basically you lending money to Uncle Sam. This is considered the safest bet on the planet. You hand over your cash for, say, 10 years, and they pay you back with interest, maybe 6% annually. This is what investors call the risk-free rate. It's your baseline. Any other investment has to promise something better than 6%, because otherwise, why bother with the risk? If Jason wants your investment in his gum empire, he better be offering returns that make that 6% look boring. But let's be real, lending money to the government is about as thrilling as watching paint dry. There's another option though, one that opens the door to much bigger rewards. You can become an owner. You can buy a piece of an actual business. That's what the stock market really is. It's not some mystical casino with random numbers flying around. It's a marketplace where you can purchase tiny slices, called shares, of real companies. The ones making your phone, brewing your coffee, or in our case, Jason's hypothetical nationwide gum empire. Let's fast forward and imagine Jason's operation has grown up. He's now running a chain called Jason's Gum Shops. Last year, after all expenses, rent, salaries, and taxes, the business cleared $1.2 million in profit. Jason decides to go public. He divides his entire company into 1 million equal shares. Since the business earned $1.2 million, each share is entitled to $1.20 of those profits. He's selling shares at $12 each. Question: is this a good deal? You're paying $12 for something that earned $1.20 last year. To figure this out, we calculate what's called the earnings yield. You just divide those earnings, $1.20, by the price $12. That gives you 10%. Now we can compare. Government bonds pay 6%. Jason's business yields 10%. Obviously 10 beats 6, right? But here's where most people's brains start smoking. That $1.20 is last year's number. What about next year? What if gum goes out of style? What if a competitor crushes him? Suddenly this feels impossibly complicated, like you need psychic powers. You're competing against thousands of Wall Street professionals with fancy degrees and unlimited coffee budgets, all trying to predict the same future. What chance do you possibly have? This is where most people give up. But this is also where Joel Greenblatt hands us an incredibly powerful tool. He introduces us to a character from investing legend Benjamin Graham. Meet your new business partner. His name is Mr. Market. And Mr. Market is, to put it kindly, emotionally unstable. He's got serious mood swings. Every single day, he shows up offering to either buy your shares or sell you his, and he names a price. Here's the beautiful part. You never have to deal with him if you don't want to. Some days, Mr. Market is absolutely euphoric. He's convinced the future is glorious and offers you ridiculously high prices for your shares, way more than they're actually worth. On those days, maybe you sell to him. Other days, he's completely depressed. He thinks the world is ending and offers to sell you his shares dirt cheap, for way less than they're worth. On those days, you should probably take advantage of his panic and buy. Most days, though, his price is neither crazy high nor stupidly low. On those days, you just ignore him and go about your life. This is the stock market. Every day, you see prices flashing for companies like Apple, Ford, or Jason's Gum Shops. Last year, General Motors stock might have traded as low as $30 and as high as $68. Did GM really double in value and then lose half in the same 12 months? Of course not. That was just Mr. Market having his episodes. Those prices on your screen aren't the true value of businesses. They're simply what Mr. Market is offering on that particular day, in that particular mood. Your job isn't to predict his emotions. Your job is to know roughly what a business is actually worth. Then wait patiently for him to offer you something ridiculous. This idea of buying something for way less than it's worth is called investing with a margin of safety. It's your insurance policy against being wrong. If you think something's worth $10 a share and you buy it at $6, you've got a huge cushion. Even if you were a bit optimistic and it's only worth $8, you still win. This all sounds great in theory, but we're back to square one. How do we figure out what a business is actually worth without becoming accounting wizards? This is where Greenblatt drops his bombshell. This is the magic formula. He realized you don't need to be a genius. You just need to focus on two things, and only two things, both remarkably simple. First, buy businesses at bargain prices. We talked about earnings yield already. Higher is better. It means you're getting more profit for your money. It's like choosing between two rental properties that cost the same, but one generates $30,000 a year and the other generates $10,000. Which would you pick? Exactly. You want businesses earning more relative to what you're paying, not less. Second, buy good businesses. But what makes a business good? Is it their products? Their leadership? Those are hard to measure. Greenblatt found a beautifully simple number to measure business quality: return on capital. Don't let the fancy terms scare you. The concept is dead simple. Return on capital asks, for every dollar this company invests in building its business, like opening stores or buying equipment, How much profit does it generate each year? Back to Jason. Say it costs him $400,000 to open one gum store. Last year, that store made $200,000 in profit. That's a 50% return on capital. That's absolutely insane in a good way. Think about where else you could invest money and reliably get 50% returns year after year. Almost nowhere. Now imagine Jason's friend Jimbo runs a chain called Just Broccoli. His stores also cost $400,000 to open, but they only make $10,000 in profit. That's a measly 2.5% return on capital. Which business would you rather own? Jason's 50% return or Jimbo's 2.5%? No contest, right? You want businesses that earn high returns on their investments. Why does this matter so much? Because a company with high returns on capital has some kind of special advantage. Some secret weapon. Maybe it's a powerful brand like Coca-Cola that lets them charge premium prices. Maybe it's unique technology or a brilliant business model. Whatever it is, that advantage protects their profits from competition. A business like Just Broccoli, with its low returns, has no real advantage. Anyone can open a broccoli store. Competition keeps profits forever low. Even better, companies earning high returns on capital have this magical compounding effect. When Jason's Gum Shops makes a profit, what can he do with that money? He could invest it in government bonds at 6%. Or he could open another gum store and earn 50%. This is how companies grow their earnings at incredible rates. It's a money-making machine that feeds itself. And that's the entire magic formula. Seriously, that's it. 2 simple steps. 1. Find companies with high return on capital, the good businesses. 2. Find companies with high earnings yield, the bargain prices. The formula systematically finds above-average companies trading at below-average prices. It's a disciplined way to exploit Mr. Market's mood swings. It finds wonderful businesses that, for whatever reason, he's decided to put on sale. So does this almost embarrassingly simple idea actually work? Greenblatt went back and tested it. He analyzed data from the largest 500 companies on the U.S. stock market over 17 years. Each year, he bought about 30 stocks that ranked highest on the magic formula, held them for a year, sold them, and repeated with the new top-ranked stocks. The results weren't just good, they were absolutely bonkers. Over those 17 years, the overall market averaged about 12.3% annually. If you'd put $11,000 in a typical index fund tracking the market, you'd have ended up with around $79,000. Not bad at all. But the magic formula portfolio? It returned approximately 30.8% per year. That same $11,000 would have exploded into well over $1 million. He more than doubled the market's return while taking on less risk. Looking at any 3-year period during those 17 years, the magic formula never lost money. The regular market, on the other hand, had periods where it lost nearly half its value. Greenblatt tested different groups too. He looked at just the largest 1,000 companies, the blue-chip stocks that even giant mutual funds buy. Even there, the formula nearly doubled the market's return. It seemed to work everywhere. Then he did something even more revealing. He divided all 500 companies into 10 groups, ranked from best to worst by the formula. Group 1 had the stocks the formula loved most. Group 10 had the ones it hated, the terrible businesses at expensive prices. The results were perfect. Group 1 performed best. Group 2 did slightly worse. Group 3 a bit worse than that, all the way down to Group 10, which had terrible returns. The formula wasn't just getting lucky. It seemed to have genuine predictive power about how groups of stocks would perform. This brings us to the most important question. It should be burning in your mind right now. If this formula is so powerful, and now it's published for everyone to see, why would it keep working? Won't everyone start using it and make all the bargains disappear? And here's the most profound lesson in the entire book. Here's the secret behind the secret. The reason the magic formula will probably keep working is that it doesn't always work. In fact, there are long, painful stretches where it fails miserably. On average, in 5 months out of every year, the magic formula underperforms the market, sometimes for a full year, sometimes for 2 years straight. Greenblatt's study found periods where it underperformed for 3 consecutive years. Now, imagine yourself in that situation. You've put your hard-earned money into a system you read about in a book. For 2.5 years, you've watched your friends who bought the hot stocks get rich, while your portfolio has gone nowhere or even down. Every financial news show is saying your strategy is dead. Your family thinks you've lost your mind. Do you have the guts to stick with it? Most people don't. The human brain isn't wired for that kind of patience. We're social creatures. We want to do what everyone else is doing, and we want results now. After a year or 2 of poor performance, most people bail out, usually at the worst possible moment, and chase whatever's been working lately. Even professional money managers can't stick with it. Their clients pull money after a few bad years, and they lose their jobs. So to protect themselves, they just buy the same popular stocks as everyone else. It's safer to fail conventionally than succeed unconventionally. And that's the beautiful, ironic reason why the opportunity still exists. The short-term unpredictability of the formula is what protects its long-term power. It's the price of admission for incredible returns. It only works for people who truly believe in the logic behind it, the timeless wisdom of buying good businesses at bargain prices, and have the discipline to stick with it through Mr. Market's darkest moods. Success isn't about having a secret formula. It's about having the strength to follow a simple, sensible plan, especially when it's really hard. Greenblatt makes it clear you have choices. You can try picking individual stocks yourself, but if you do that, you need to be willing to do the hard work of truly understanding businesses and estimating their future earnings. If you can't do that, he says bluntly, you have no business buying individual stocks. For those who can, he suggests owning just a handful, 5 to 8 of your very best ideas. But for the other 99% of us, the path is simpler. You can put your money in an index fund, which just matches the market's average return. There's zero shame in that. Earning the market's average return of around 10% annually over the long run is a fantastic outcome. Or, if you want to do better, you can follow the formula. You can build a portfolio of 20 to 30 of these high-quality, bargain-priced companies. You don't need to understand every detail of every business. You just have to trust that, on average, the simple principles of value will win over time. In the end, this little book isn't really about a formula. It's a profound lesson in how the world actually works. It teaches you to separate price from value, to ignore the noise of the crowd, and to trust simple, timeless logic. It acknowledges that the greatest challenges in investing aren't financial, they're emotional, and the greatest rewards go to those who can master their own psychology. What I find so powerful about Joel Greenblatt's work is how he demystifies a world that seems intentionally intimidating. Wall Street thrives on complexity, jargon, and the idea that you need superhuman intelligence to succeed. This book just gently pulls back the curtain and shows you that successful investing is based on principles a 6th grader selling gum can understand. The central lesson isn't a stock-picking trick. It's a philosophy. It's about being a business owner, not a stock trader. When you buy a share, you're purchasing a piece of a real company, with real assets and real earnings. Your long-term success depends entirely on that underlying business's success, and the price you paid for your piece of it. That's it. Everything else is just noise. The Mr. Market analogy is one of the most brilliant teaching tools ever conceived. It perfectly captures the emotional, often irrational nature of the market while empowering you. It reframes your relationship with the market from fear and confusion to opportunity. You're not at the mercy of the market's whims. You're its calm, rational partner, waiting patiently to take advantage of its occasional fits of madness. The magic formula itself is beautiful in its simplicity. It distills decades of investing wisdom into 2 core pillars: quality and price. Buy good things and buy them cheap. It's a principle that applies not just to stocks, but to almost anything you buy in life. Yet in finance, it's somehow revolutionary. The most important takeaway for me, though, is the psychological one. Greenblatt's ultimate point is that knowledge isn't enough. The formula is simple to understand, but it's not easy to follow. Its biggest strength, that it works over the long term, is also its biggest challenge, because it requires a level of patience and emotional strength that's incredibly rare. So how can you start applying this wisdom today? Here are a few simple actions. First, change your perspective. Next time you see a stock price flashing on a screen, don't see it as just a number. See it as Mr. Market's offer for a piece of a real business. Ask yourself, is he feeling euphoric today or terrified? This simple mental shift is the first step toward becoming a true investor. Second, embrace a long-term horizon. Greenblatt suggests a minimum of 3 to 5 years. This isn't a get-rich-quick scheme, it's a get-rich-patiently plan. Deciding up front that you won't judge your results based on the next quarter or even the next year is liberating. It frees you from the daily anxiety that plagues most market participants. And third, if this approach resonates with you, you can actually see it in action. Greenblatt created a website, magicformulainvesting.com, where he provides a list of top-ranked stocks based on the formula, for free. You don't even have to invest. Just go look. See what kinds of companies the formula picks. It's a fascinating and practical way to make these concepts feel real. That was the book summary of The Little Book That Still Beats the Market by Joel Greenblatt. We've covered the big ideas today: Jason's story, the wisdom of Mr. Market, and the simple power of the magic formula. But a summary, no matter how detailed, is like looking at a photograph of a great meal. You can see what's in it, but you can't taste it. The real magic happens when you sit down with the book yourself. It's in the way Greenblatt's clear, fatherly voice guides you through these concepts, making you feel not just smarter, but wiser. If anything we've talked about today sparked something in you, I encourage you to grab a copy. Reading it isn't just about learning an investment strategy. It's about building a foundation of financial wisdom that can serve you for the rest of your life. A link to the book is in the description below. Also, if you found this summary valuable and want to continue exploring ideas from the world's most powerful books, please hit that like button and subscribe to the channel. It tells us we're on the right track, and it ensures you won't miss our next journey into another life-changing book from the billionaire's bookshelf. Let's keep growing together.